Hey, I'm Adam Fortuna, the creator of Minafi and your guide for the Minafi Investor Bootcamp. I'm so excited that you've decided to take control of your financial destiny and learn how to invest on your own. Learning the basics of how to invest is a skill that you can pick up in a weekend, but it'll probably take many months or even years to get to the point where you can confidently invest on your own, month to month, without feeling scared about where your money's going. You're watching the course, Why Should You Invest in the Stock Market? In this course, we're going to dig into why the stock market is so often referred to as the best place to invest. We're also going to look into how you actually invest in the stock market. It's kind of important. And lastly, we're going to look at some of the most common mistakes people make when they get started investing. For starters, in this first lesson, we're going to start off by just looking at this question: why do so many people say you should invest in the stock market? What exactly do people mean when they say that? But first, a caveat before we get started. I am not an investing expert or a certified financial planner. I spent most of my career as a software engineer and a product manager, mostly teaching people how to code. Teaching people how to code and teaching people how to invest have a lot of similarities. There's a bit of a learning curve getting started, but then once you're confident in both of them, you feel like you can take on the world. At that same time, I was going home at night and reading books, blogs, newspapers, pretty much anything I could that helped me learn more about how to invest and grow wealth. And during that time, I learned a lot of different techniques, some of them a lot more scammy than others. When it comes to investing, you have a lot of different choices. You can pick stocks, you can invest in real estate, there's cryptocurrency and peer-to-peer lending, there's commodities like gold, and countless other ways. If you do a search for investing and try to find where to get started, it is a minefield. There are really good people recommending really good techniques to grow your wealth, but they're right in search results next to someone who has come up with a great way of how to scam people for money in a way that looks like an investment. When I got started investing, I didn't know where to start, so I went down every rabbit hole I could and learned the basics of a lot of different things. What I soon learned was that there is a really big difference between speculative investing and long-term investing. So what I mean by that is speculative investing is about putting your money into an investment or something at a specific time with the intention of selling it at a specific time later to make a profit. It's highly speculative because you need to know and be right about the time when you put the money in and be right about the time when you take the money out. An example of speculative investing would be real estate. There's nothing wrong with investing with real estate. I know a lot of people who have made a lot of money doing it, but it's highly dependent on you finding the right place to buy and the right time to buy. That's why a lot of people say money is made when you make the purchase when it comes to real estate. Long-term investing is a lot different. Long-term investing is less about finding the exact moment to invest and more about finding things that you can invest in that will be solid for you to invest in for 10, 20 years, or your entire lifetime. So chances are you've heard the phrase, you should invest in the stock market. And it's usually followed by a lot of exclamation points and enthusiasm about how someone invested in Apple before they had a huge break, or maybe in Tesla before the first car was released. There are many, many different ways to invest in the stock market. And that one is called individual stock picking. It's exactly what it sounds like. It's finding a company that you think is going to grow and putting your money in at a time when you think there's room for growth. The hope there is that the company will come up with something new, maybe it'll rise in value, and the stock price will rise and you'll be able to sell it for a gain. It's probably the most public investment strategy out there, but it's also absolutely not the way that most people need to invest. Let me explain why. The problem with individual stock picking is the same as for the speculative investments we talked about earlier. You need to be right not just about the company, but you need to be right about when you invest and when you sell. And to do that, you need to know a lot about the company. Actually, you need to know more about the company than the experts do. The price of a stock is a reflection of all knowledge that's known about that company and the industry and the global economy. So investment companies spend a lot of money on research. They know so much more about every single company that you want to invest in than you or I ever could. For instance, they need to know not just about the product lineup, they need to know about maybe staffing issues the company has, fulfillment issues in factories around the world. They need to know what marketing challenges are out there. They need to know about how every single one of their competitors might change or take over some of their market shares. And they need to constantly be on top of this knowledge. So, to be honest, individual stock picking is a treadmill of news. You need to constantly be ingesting new information about the company, iterating on it, and maybe buying or selling based on it. It is a lot of work. It's easy to look back at a company like Apple or Tesla and think, yeah, of course they went up. I knew they would. But would you have bet your ability to retire or your life savings on that company? If the company had a bad period, then you would probably lose a lot of money. And should the company go out of business, you might lose everything. If you had invested in Apple during the 1990s, you would have lost a lot of money. Not only did the company stock stay relatively flat, compared to most other investments you could have made at that time, your money could have doubled or tripled during that same period. In other words, picking the right company isn't enough. You need to pick them at the right time, both to get in and to get out. So luckily, there is a better way to invest that doesn't require betting your life savings on a single company or just a few. It's called diversified index fund investing, and that's the premise of this entire bootcamp. Here's how it works. So once a company has decided to go public, they're effectively selling tiny pieces of their company on a public exchange, like for instance, the New York Stock Exchange or the NASDAQ, which are the largest two exchanges in the United States. This one, the New York Stock Exchange, has about a 23 trillion market share, and NASDAQ has about 11 trillion. And each of these exchanges has thousands of stocks and companies represented within it. Now, if you've ever tuned into business news on cable or watched Kai Ryssdal give the numbers on NPR Marketplace, you've probably heard him mention either the Dow Jones Industrial Average or maybe the NASDAQ Composite, or most commonly the S&P 500 index. These are usually mentioned as indicators of the economy and how it's doing for that given day. Whether that's a useful indicator or not, probably not. But if you are invested in the stock market, it's an indicator of whether or not your portfolio is going up or down for that day. The Dow Jones, NASDAQ, and S&P 500 all represent a single investment in a bunch of different companies. So for example, the Dow Jones Industrial Index represents an investment in these 30 companies from a number of different market sectors. So for instance, this includes an investment in American Express, which is a financial services company, in Apple, which is information technology, in Coke, which is food, in Merck, which is pharmaceutical, Nike, which is apparel. So these companies represent a broad sector of the economy across lots of different industries. The NASDAQ index mostly represents an investment in technology companies, since most of the companies listed in the NASDAQ are technology focused. The most popular index, and the one that even Warren Buffett recommends, is called the S&P 500 index, which stands for Standard & Poor's 500. It includes the largest 500 companies in the United States based on the size of those companies. Some of those companies are listed in the New York Stock Exchange, some of them are in the NASDAQ, but really you don't need to worry about where they're traded. This means that behind the scenes, this one investment in the S&P 500 is actually like you're investing in 500 different companies. It's also a rotating index. What that means is that as a company falls out of the top 500, maybe they fall from 500th place to 501st place, all of a sudden, whoever leaps up to the 500th spot is now part of the index, and whoever's in the 501st spot is no longer part of the index. When most people say you should invest in the stock market, this is what they mean. By owning an index fund, like an S&P 500 index fund, you're effectively investing in 500 different companies. And not just any 500 companies, but the largest companies in the United States. What's great is you don't need to worry about picking out individual stocks. You just invest in this one index fund, and it'll invest in 500 companies for you. In the next lesson, we're going to dig more into index funds and see why people like Warren Buffett, robo-advisors, financial advisors, and this bootcamp all recommend using them as the best way to invest in the stock market. Okay, let's review this lesson's 3 main points. Number 1, when people say you should invest in the stock market, what they mean is transferring money that you've made through your job or other means and using it to buy shares in companies that are listed in a public stock exchange like the New York Stock Exchange or the NASDAQ. You're effectively buying a very small piece of that company with the hope that it'll rise in value and distribute some of that wealth back to you in some way. Number 2, there are better ways to invest in the stock market than just picking a single company and putting all of your money into it. If you're investing by trying to pick individual stocks, you might as well be placing bets on horses. Not only do you have to pick the right horse, but you have to pick the right race. It is extremely difficult to invest long-term by picking individual stocks. Rather than trying to invest in a single company, the way that most people grow their wealth in the stock market is by using index funds. Index funds invest in a number of different companies behind the scenes, allowing you to invest in just one thing and have them do the work of picking the stocks for you. The stocks that an index fund invests in automatically change to match that fund's criteria. For example, the S&P 500 includes the largest 500 companies in the United States, and it automatically changes when companies grow or shrink in value. You can invest in just that one index fund and not need to worry about checking the news or acting on price fluctuations. Warren Buffett has a quote about investing that paints an important picture about what it means to invest. Business schools reward complex behavior more than simple behavior, but simple behavior is more effective. Warren Buffett, a man who's made it his life's work to invest, favors a simple approach. Many of us are taught from an early age not to talk about money, not to share our salaries, not to say what we're doing from an investment standpoint, and that leads to this idea that investing is a lot more difficult than it really is. Investing can be really simple, and the basics of investing that Warren Buffett talks about are extremely easy to learn. In the next lesson, we're going to look into how index funds play a crucial role in a good investment strategy. See you then.